So today I'm going to focus on Topicus. This is one of Constellation Software's spin-offs. And really it's all about long-term value creation through systematic merger and acquisition excellence. So the inspiration for today's presentation came from the Lattice work earlier this month, the Lattice work meeting at the Yale Club in New York. So there was an interview with Ed Wackenheim from Greenhaven Associates, and the interviewer focused in part on the Bessenbinder study. So for those of you that aren't familiar with it, Professor Bessenbinder looked at 100 years of stock market data, and he concluded that all of the wealth creation had come effectively from 4% of companies. And so the interviewer was asking that, a reasonable man would find that 4%, buy it, hold it forever, which certainly sits with the Phil Fisher and Buffett and Munger type philosophy on investing. So the question that was put to Ed Wackenheim was, is this the approach you adopt at Greenhaven Associates? So in response, he said that, his goal is for a 15 to 20% annual return. And that in his experience, very few companies can sustain growth of 15 to 20% for decades. So he doesn't hold on for the long term. Instead, his goal is achieved through buying well. He looks for multiple expansion opportunities and, of course, some growth. And then when his investment thesis unfolds, he locks in the gain and he moves on. And he explained that his average holding period for this reason is somewhere in the region of 3 to 4 years. And that caused me to reflect, because that answer is good as far as it goes, but it only tells half the story. So there's a growth paradox, and in reality, Ed Wackenheim was right. Sustaining organic growth above inflation at double-digit rates for decades is almost impossible. And so the response of most companies is to spend more on mergers and acquisitions, effectively to acquire growth, which is why M&A accounts for the largest proportion of capital allocation across the board. But here's the problem. A Harvard Business Review revealed that over 60% of acquisitions actually destroy shareholder capital. So let's have a quick visit of the M&A Hall of Shame and Fame. So let's start off with some horror stories. You probably remember when Microsoft paid 7.2 billion for Nokia. It was trying to break into the smartphone market. It failed miserably. It resulted in 18,000 layoffs. It was a complete disaster and, of course, a waste of capital. And then there was the Google story. It paid 12.5 billion for Motorola. Again, trying to kind of break into the smartphone market. It exited 2 years later when it sold Motorola to Lenovo for 3 billion. And so it effectively destroyed 9.5 billion of shareholder capital. Now, common failure points with M&A are wildly optimistic synergy assumptions, overpaying ridiculous prices, rushed due diligence, botched integration. This is where most go wrong. And of course, the incentives being wrong, ego-driven empire building. So, just buying for the sake of buying, which makes no strategic sense. At the bottom of this page, you can see, where acquisition done properly, it can pay huge dividends. So we all know the history of Berkshire Hathaway. It's invested long-term capital in high-quality businesses, both in the public and private markets, and it's enjoyed decades of compounded growth. TransDigm is a slightly different story, and it's achieved monopolistic power in mission-critical industries, particularly the aerospace industry. And it generates high margins and steady cash flows to fuel more acquisitions. And so the flywheel keeps spinning. So while we're talking about acquirers, let's think about taxonomy, because this is where I hear a lot of investors get very, very confused. Now, there are 4 types of acquirers. So the first type I have here are the speculative acquirers, and this is best exemplified by the private equity model. It's effectively short-term capital. They buy a company, they try to restructure it, they slash costs, they load it with debt, they flip it out, typically a 3 to 5 year turnaround period. The business is flipped out before the damage becomes evident most of the time. And there's a huge misalignment of interests. I mean, I'm sure you remember the Toys R Us disaster. It was a great business. Private equity stepped in and Toys R Us was completely defunct and it failed subsequently. Then number two is the ad hoc acquirers. These are occasional strategic acquirers. And of course, they're buying to achieve some kind of horizontal or vertical integration. It's very risky because, you know, they're not well practiced necessarily in acquisitions, and these tend to be elephant hunting deals. And so, you know, we've just discussed the Microsoft and Google disasters, and those are perfect examples of where ad hoc acquirers go wrong. And then you've got serial acquirers. Now, these are a specific type. These are typically industry roll-ups. And they're typically dangerous because they come with the wrong incentives. You know, executives are rewarded for growth, not necessarily for value creation. Now, the gold standard, as far as serial acquirers is concerned, is Brad Jacobs. You know, he typically consolidates within an industry and creates a lot of value. You know, he's done this 4 times. I think he's on his 5th rodeo now with QXO. But most of these tend to go wrong. There's also a lot of competition. You know, if there's an industry which lends itself to consolidation, there are a lot of companies out there who would quite like to consolidate. So everyone's rushing to buy whatever company may come available, which creates a lot of competition. It results in overpaying. And so most go wrong. Brad Jacobs is the exception, not the rule. And then the fourth type, the type that we're focused on today, is what I call programmatic acquirers. And this terminology came from McKinsey, but I quite like it. And programmatic acquirers are very different from serial acquirers. So whereas the serial acquirers are focused on rolling up businesses within a holding company, and there's a lot of integration involved, programmatic acquirers are completely different. So they adopt, so I call this, incidentally, this is my terminology, acquisition as a business, because that's what programmatic acquirers are doing. Their business model is running a holding company which focuses on acquiring lots of small companies, but keeping them independent. And you know that's really important. So they adopt a repeatable, systematic, surgical approach to their acquisitions, and they transform M&A into craftsmanship. And they apply permanent capital, which means that there's perfect alignment and there's low risk. So that's really the topic. That's what we're focused on here. And Topicus, the subject of today's presentation, is certainly a programmatic acquirer. And it was spun out of Constellation Software, which, as we all know, is run by, or has until recently been run by, Mark Leonard, who founded it. And he explained that it isn't about empire building. It's about optimizing the risk-adjusted returns on capital. And I think that sums it up very well. So what makes programmatic acquirers different? So first of all, they apply permanent capital. So they're in this for the long run. They're completely different to the private equity acquirers who want to flip a company out in 3 to 5 years. You know, if your only interest is to buy a company to optimize the optics in terms of earnings in order to flip it out for the best multiple within 3 to 5 years, then you don't really care about the long-term success of that business. And none of the decisions you're going to make are long-term focused. You're going to be long gone after 3 to 5 years. So do you really care about what this company will look like in 10 years' time? No, you won't. But programmatic acquirers is different. They apply permanent capital. They're in this for the long run, and they really do care about the long-term success of the business in which they invest. Now they target niche businesses that most other acquirers overlook. So whereas the serial acquirers are all fighting over the same pool of mum and pop shops, perhaps, you know, to roll up into a bigger consolidated entity in order to achieve economies of scale, programmatic acquirers aren't doing that. They're not interested in roll-ups or synergies, as we'll come to discuss a little bit later. They're looking at niche private businesses, typically small companies, that churn a lot of cash, but don't necessarily have the opportunity to reinvest that capital. And so as a small private company, the owners are extracting that cash flow to fund their lifestyles, but there isn't very much growth that goes on. So the programmatic acquirers, they scoop up these companies, they consolidate the cash flow that these companies are generating, and then, you know, of course, cash doesn't have to be invested where it was generated. And so the programmatic acquirers use that capital to fund the acquisition machine, and so it goes on. And so you've got this fantastic flywheel that keeps turning. But because these are mum and pop shops in the private sector, relatively small, don't have great growth opportunities, they don't attract a lot of attention from other acquirers or from private equity firms, which is great because that means programmatic acquirers can pick them up relatively cheap with good kind of multiples. As we've already mentioned, programmatic acquirers aren't interested in consolidation or synergies, so they avoid the integration risk. These businesses carry on after acquisition almost identically to the way they were before, just with a change of ownership at the top. So they're immediately accretive, and there's no money consumed in complicated integration. And finally, programmatic acquirers pretty much industrialize the M&A process, and this is really, really important. And I'm going to come back to this a bit later. The process is everything. So I don't know if you're familiar with Momentum Group. It's a Swedish programmatic acquirer, and for reasons that I don't fully understand, Sweden is a hotbed of programmatic acquirers. It's created a lot of them, and a lot of them are hugely successful. Momentum Group is one of those. And Nicholas Enmark, who was the CFO of Momentum Group, explained that the acquisition process for them is not just a process for closing the transaction. It's the basis for getting to know the company that they're looking to acquire and its people. The chemistry is all important. And this is really important as well. This is one of the reasons that they manage everything, the whole acquisition process in-house. They don't outsource it to consultants or M&A lawyers, or other kind of third-party advisors. Everything is done in-house, and they keep that process really, really tight. So across these programmatic acquirers, there's a convergent approach. As we've already mentioned, they don't chase synergies or integration. There is no integration risk, which is a huge benefit. And it's all about decentralization. And this is a recurring theme. It's what I call a golden thread. And this is not a coincidence. I've got 3 quotes here to share with you. So Lifco, a very famous CEO, a very famous Swedish programmatic acquirer, was run for many years by Fredrik Karlsson, who has now moved across to a company called Rocco, another programmatic acquirer in Sweden. And he explained that it's really difficult for someone outside of the programmatic acquirer space to understand what decentralization is done properly because they've never experienced it themselves. He said that people always ask about synergies, but it's very difficult to tell them that programmatic acquirers really don't care about synergies. If the synergies come, then that's all well and good, but that's not why they invest in a company. They just buy good businesses and they want to nurture those good businesses and keep the cash flowing. That's the all important thing. Similarly, Nicholas Stenberg from AdTech, another Swedish programmatic acquirer, explained we don't push synergies, same thing. If you ask me, the decentralized responsibility is more important than anything else. He said if we start taking too many decisions top down, just trying to centralize management, then they will ruin the entire culture that they've sought to nurture. And Warren Buffett has a very, very similar approach, and he's explained that all of the businesses that Berkshire owns are run autonomously to an extraordinary degree. He said that when they buy a business, the sellers go on running it just as they did before the sale. He said Berkshire Hathaway adopts to their methods rather than vice versa. So you can see that there's this golden thread that runs through all of these programmatic acquirers. And Berkshire Hathaway is, of course, another fantastic example of a programmatic acquirer. It's got a disparate collection of businesses, both public and private, and the compounding speaks for itself. So why invest in a programmatic acquirer? So there are 3 key reasons I've pulled out here. One is a kind of a multiple arbitrage. So private companies are typically available at lower valuations. They're arguably undervalued because they're off the radar. They're off the menu of most acquirers. So when they're acquired by a publicly run programmatic acquirer, then they're kind of rolled into that public company, which trade at premium valuations, and arguably some of that trapped value, that hidden value, is unlocked. Then you've got the built-in diversification. So a programmatic acquirer that keeps acquiring and acquiring tens, if not hundreds of companies, has fragility, as Nicholas Taleb likes to describe it. It smooths the cyclicality and the earnings across the portfolio. So you've got a great benefit there. It's almost like being invested in a diverse portfolio, but of course you've got it within a programmatic acquirer. And that brings me on to the last benefit, which is no fees. So you've got the best of both worlds. You've got effectively a quasi-active fund management setup without the crushing 2 and 20 fee structure that destroys long-term returns. So there are 10 key ingredients of a great programmatic acquirer. You've got the permanent capital, which instills truly long-term thinking. They look for high marginal returns on reinvested capital, typically 15% and above. They look to limit capital leakage. So what you tend to see in the best programmatic acquirers is they tend to avoid dividends. They may pay them on an ad hoc basis, but it certainly isn't done as a matter of course. All of the capital is reinvested in growth where possible, and only if there's a surplus will a dividend be paid out. And the best programmatic acquirers avoid stock-based compensation. They optimize reinvestment. And then, on the subject of reinvestment, they have really aggressive reinvestment rates, and some of the better programmatic acquirers can achieve reinvestment rates above 100% of retained earnings, and they do that with a conservative use of debt. Then they've got this relentless discipline. We've already discussed the process, that they're process driven, and I'm going to come back to this shortly. We're going to dive into a bit more detail there. And there are dual engines for growth. You've got both the organic growth and, of course, the acquisitive growth. Now, something that's very important to call out here is that not every acquired company needs to grow. And the Constellation software group, of which Topicus is a part, has never been particularly focused heavily on organic growth. For them, it's about acquiring predictable cash flows and harvesting those cash flows, deploying them where they can be used most productively, which then fuels that M&A flywheel. And for the Constellation group, if there isn't a great opportunity for organic growth, it's a good opportunity to pick up the acquisition more cheaply, which kind of works in their favor. That's part of their process. But there is always an opportunity for organic growth if you can apply a model into a different geographic region or new distribution channels. So you've got those dual engines of growth. Then you've got recurring cash flows. So they tend to invest in sticky products or services where you have very, very high recurring revenues and low churn rates in terms of customers. These are self-financing models as well. So there are no constant capital raises. As the cash is generated by the acquired businesses of the past, so that money is used to acquire new businesses going forward, and the business keeps compounding and the flywheel keeps turning. There's very little, if any, dilution. They avoid equity raises, and as I've already mentioned, stock-based compensation is generally frowned upon. And there's a high degree of insider ownership. And this is importantly, the better programmatic acquirers. So you can focus on Constellation software, but you can also think about Berkshire Hathaway here. Insider ownership is bought by insiders. It isn't granted. So incentives are very much aligned with external investors. So I've got a quote here from Larry Mendelson of Heiko. Once again, another programmatic acquirer. And he focuses here on the cash flows. Cash flows are everything. And he says that we're not an aerospace company. We're rather a vehicle that generates strong cash flow through aerospace parts and technology. And he explains the key is always the cash flows, which I found to be interesting, and it kind of sums this up nicely. So these programmatic acquirers have a stunning track record. I've listed a few here. We've got Lagercrantz, which is one of the Swedish serial acquirers. They've generated 23% CAGR for their shareholders over 25 years. The Danaher Corporation, I'm sure you're familiar with that. Over a longer period, 35 years, they've generated 12% compounded returns. They've engaged in over 400 acquisitions, and very famously, they have something called the Danaher Business System. And this goes back to something I said earlier. It's all about process. These businesses, the ones that do it properly, are process driven. And the Danaher Business System, which others have tried to replicate, is a perfect example of how that process in practice. And then Constellation Software is really the kind of the subject of this presentation, because we're focused on Topicus, which was spun out of Constellation. Now, Constellation is the poster child for the programmatic acquirer model. Over the last 20 years since its IPO in 2006, it's generated a 37% annual return for shareholders. It's made over 900 acquisitions of niche software companies. And just put a note here that had you invested 2.5 million at that IPO in 2006, 19 years later, it would have grown to $1 billion today. Really quite astounding. Even more astounding is it's still growing at similar rates. So here's Mark Leonard, the wizard behind the magic, and he very much looks like a wizard as well. So his playbook is always buying microcap software companies, vertical software, and I'll kind of come back to this shortly. But of course, successful companies eventually run into the laws of large numbers. Constellation Software is worth tens of billions now. So, how do you carry on buying caps when you're such a huge company? You've got a mountain of capital to deploy because all of the companies you've acquired in the past are throwing out this free cash flow. So what do? Do you continue hunting small game, or do you become an elephant hunter? Now, I've got some examples of different approaches here. You may or may not be aware of a company called Judges Scientific. It's a British programmatic acquirer, and they're very much focused on scientific instruments. Now, they've grown at 22% CAGR over the last 20 years, but they decided, for some reasons that are kind of beyond my comprehension, to go elephant hunting. And they acquired a company called Geotech, which was a break from their playbook. So that one acquisition cost them more than the 20 years of acquisitions they've made previously combined. It gives you an idea of the scale and why I explain that kind of an elephant hunting expedition. So they also paid a far higher multiple than they paid in the past. They aimed for 4 or 5 times EBITDA multiples, but they paid over 7 times for Geotech. It was a service company, whereas in the past they'd always acquired product companies. So again, another departure from the playbook. And they introduced a lot of concentration risks because this was a huge acquisition. And so they were almost betting the farm on this one acquisition rather than distributing the risk over a large number of smaller acquisitions. Needless to say, it backfired. And Judges Scientific has suffered a market cap fall of 50% as a result of this going kind of horribly wrong, at least in the short term. They may be able to turn it around, but it didn't go well. And so, the bottom line here is if you've got a playbook and it works, stick to it. If it isn't broke, why fix it? Now, Berkshire Hathaway have also fallen into the elephant trap, although in a slightly different way. As we all know, they're sitting on a mountain of cash, about $350 billion. And Warren Buffett explained that there remain only a handful of companies in this country, in the US, of truly moving the needle for Berkshire Hathaway. The problem for him is that he just can't find anything big enough to deploy capital to make a difference. Now, this is the really interesting part. Excuse me a second. Sorry about that. Mark Leonard took a completely different approach to both Judges Scientific and Berkshire Hathaway. He stuck to the playbook. He chose volume over going elephant hunting. And the way he did this is fascinating. So he chose extreme decentralization, and he adopted a methodology which internally was described as keep your capital, KYC. Essentially, he broke Constellation into different platforms. And the platforms assumed capital allocation decisions. So whereas most companies that focus on decentralization keep capitalization at the holding company level and everything else is decentralized, operations is decentralized, Mark Leonard took it a stage further and he even decentralized the capital allocation. So as you can see, I've got this quote from him on the right here. He said, "We take operators and convert them into capital deployers." And that's really the magic at the heart of what's made Constellation so successful. So they've got a compensation model, which is linked to return on invested capital, and they target 25%. And of course, the closer you get to that 25%, the better your compensation is likely to be. So it encourages managers of these platforms to focus very heavily on where to deploy capital. They look at M&A, they look at R&D, and they have zero stock-based compensation. There's none of it at all. Mark Leonard has always encouraged his staff to buy stock in the company through the market. If the chef isn't interested in eating his own cooking, then you've got something to be worried about. And Mark Leonard understood that from an early stage. So you've got these managers who are encouraged to allocate capital, to focus on opportunity cost between M&A and R&D, and they're focused on return on invested capital. So it's all about that kind of return on incremental capital, and that's why they tend to make the kind of best decisions at any given time. And the beauty of this model is it scales perfectly. So believe it or not, the run rate of acquisitions at Constellation Software is 130 per year currently. Now, just take a pause and think about that. There are 220 working days in any given year. So 130 acquisitions a year means that they're doing more than one every other day. It's mind-boggling, but it kind of explains why they couldn't centralize capital allocation. It would be impossible for head office to manage an acquisition every other day or more than every other day. But by decentralizing capital allocation, they've been able to achieve exactly that. So, essentially they grow big by staying small scale. Every time the company grows to a certain scale, they break off another platform. And then they run the same playbook within that platform. So each platform focuses on a high volume of small acquisitions, and the benefit here is they've got a better risk distribution. The strong performers offset the weak ones, and so no single acquisition can dramatically impact results. So they're never going to find themselves in a situation that Judges Scientific found themselves in, which is encouraging. It's really, really good management. And it also creates the opportunity to spin off some of these platforms. So, they break off into platforms as the company gets bigger. I don't think any platform has more than 100 companies within it. And then, as it gets bigger, it gets broken into other platforms. And that's created this opportunity to spin off some of these platforms to focus on niche markets. And that really kind of brings us to the focus of attention today, which is Topicus. Now, this was one of these platforms that was spun out in 2021. And it's effectively running the Constellation Playbook, but with a focus on Europe. Constellation Software has primarily focused on North America. Now, there's a huge competitive advantage that most people don't appreciate within the Constellation group, and Topicus benefit from this competitive advantage. So let me explain it to you. First of all, they're industry agnostic. They're technology focused. So whereas most acquirers will focus on a particular industry, by focusing on an industry, they're going to be very much exposed to cyclicality within the industry. Topicus and the Constellation Group don't have that. They're industry agnostic, so they don't suffer from cyclicality. Their focus is software, and they're by any software company, doesn't matter what industry it's in. So they've got great diversification. Now, the key, and this is something that really most people don't appreciate, is the process that they adopt is entirely different to any other programmatic acquirer. And it's very, very difficult to replicate. This is their key advantage. They've got a Salesforce database that they use, which contains over 100,000 companies. Most of these companies are not for sale, but effectively what they do is they try to find every privately owned um, software company globally within this Constellation Salesforce database. And every time they find a new company, it goes into the database, and so the database is constantly growing. And they have business managers that nurture relationships with each of these 100,000 companies. And each one of these companies is contacted at least once a year. Now, the really important thing here is that the business managers are not finance people. So when they pick up the phone to these software companies, they're not talking about EBITDA and distribution channels and such like. Instead, they're focused on software. These business managers come from a software background. And they speak the language of the founders and the CEOs of these software companies. And they can discuss very candidly, pain points in the business, in operations, and strike up just a great informal relationship. And they're not pushing necessarily to acquire the business. As I say, most of these companies aren't necessarily for sale. What they're doing is they're looking to nurture a relationship so that eventually, when one of these companies becomes available for sale, who's likely to get the first call? It's going to be that business manager you've created a great relationship with. And it might not happen for a year, 2 years, 5 years, even 10 years into the future. That doesn't matter. When it happens, the Constellation Group want to be in pole position to grab that opportunity. And just to give you an idea, these business managers nurture these relationships over many years. And there's a rule within the Constellation Group that if a business manager hasn't made contact with the company they're responsible for in a year, that company then is flagged within Salesforce and it becomes available for another business manager to grab. Which creates this really competitive environment within the Constellation Group, and it encourages people. It creates this incentive for them to ensure that they follow up regularly. Otherwise, they're going to lose that contact. Now, we mentioned on the last slide that the Constellation Group acquires about 130 companies a year. Now, think about 130 companies in the context of 100,000 companies that they're in touch with through their database. The conversion rate is remarkably low, 0.13%. Now, most other companies wouldn't bother with this kind of thing. It seems like a lot of work for very little payback. But the point is, you don't know when a company is going to become available for sale. You may reach out to a CEO and a founder who's 30 or 40 years old who doesn't plan to sell for 20 years into the future. But anything could happen. There could be a family crisis, could be a health matter, and all of a sudden the founder needs to sell the company and to find a buyer quickly, and they've got that relationship with Constellation, so Constellation get the call. So Constellation they only source acquisitions through this channel. They don't use brokers, they don't use auctions. And that compares quite dramatically to other programmatic acquirers. So Lifco, one of the very successful Swedish programmatic acquirers, their CEO said that you can only buy a business that's for sale. We're not interested in reaching out to companies that are for sale. That's why we use brokers. It's the most efficient way. We find which companies are for sale and we'll compete. We're prepared to pay a slightly higher price. But of course, the economics are completely different for Constellation, for Lifco, simply because of the way they seek to acquire. As I've already explained, the Constellation Group are happy buying low growth or even no growth companies. Lifco and others are only seeking companies with high organic growth potential. So again, you've got the Constellation Group, they're fishing in a pool where not many other people are prepared to fish, which again is fantastic in terms of the kind of multiples they're able to achieve when they acquire. They provide bridging finance. Now, this is really important. One of the things they look for is a really good succession plan within the companies that they acquire. And they like to see promotion from within. If you're promoting from within, you're retaining the culture. Those people from within understand how the business is run. They've also got the relationships to continue. The problem is that when the CEO and the founder steps down, you've got a lot of these managers within who can get promoted, but they don't necessarily have access to the capital to buy out the CEO founder. So what do? Well, Constellation comes along and they bridge that gap. They provide the financing, and it's a win-win for everybody. The founder manages to cash in some of his chips, perhaps not all, but cash in as much as he wants to. The internal management get to step up, and they can continue running the business. And the Constellation Group managed to acquire a wonderful company, which is churning cash and has continuity of operations because you've got that promotion from within and nothing changes after the CEO and the founder steps away. So it really is kind of a win-win for all concerned. And this is their unique process. This is their edge. And nobody else does it the way the Constellation Group do. And Topicus have access to this Salesforce database. And they run exactly the same playbook. So the next question a lot of people ask is, are there enough businesses to acquire? And in answer to that question, it's very simple. So let's look at Topicus. In Europe, 99.8% of companies are small. They've got less than 250 employees. Now, there are 31 million businesses registered in the EU, but listed companies only make up single-digit thousands. So you can see that, the percentage of private companies that Topicus can go after is enormous. It's the majority of the market. There's almost 31 million of them. Added to which, new companies are constantly coming into existence, and every company will eventually be for sale. So the runway is essentially limitless. Now, not all of these are software companies, but there are enough software companies for Topicus to go after. One of the benefits Topicus has over Constellation is that in Europe, multiples tend to be lower than in North America. Added to which, there's less competition, which means that they can make better acquisitions. The other thing a lot of people don't appreciate is the barriers to entry in the European market. Both, there's the culture, there's regulation, but there's also language. Now, in North America, you've pretty much got three languages. You've got English is probably the most widely spoken. You've also got Spanish and you've got French in Canada. Three languages, you've pretty much got the continent covered. In the EU, there are 24 official languages, but there are 287 indigenous languages across Europe. And so, that's a formidable barrier. Now, Topicus has operations and people, across various regions, and it can, but through scale, it can effectively penetrate these cultural differences and these language barriers. But it acts as a deterrent for others to kind of enter this market and to compete. So Topicus has a huge local expertise.